Hey guys, how are you? Eric Bramlett, and I'm here with Max Leaman.
Hey guys.
It's What's Your Angle? Today we're going to discuss the 2023 real estate and mortgage market. We're going to recap that. We will also discuss the 2024 market and market predictions. Knock on wood, we get some of those right. And as always, we're going to provide some actionable insights, what industry professionals should focus on moving into this year in 2024. So Max, thanks so much. I mean, like a guest, we do this all the time, but I always enjoy sitting down with you, and it's been a bit. We haven't seen each other since before the holidays.
Yeah, no, it's good to see you. It's good to be here. Your office looks a little bit different.
Yeah.
Got some boxes in the background. What's going on? You get demoted?
Yeah, I did. I got demoted on a janitor. No, we hired somebody else, and we're in this office transition right now. So I got pushed into the room actually where I keep my snowboard and biking stuff. You're on Office Space, the stapler guy. How they were like trying to fire him, and so they kept like moving him into the worse and worse offices. And I feel like that's what Bailey and Shelby are doing to me right now. So yeah, this might be one of my last podcasts with you, Max.
Nice. Well, welcome back. Happy New Year.
Yeah, absolutely. Happy New Year to you. It looks like you guys had a good time. I know I had a good time as well. So.
Yeah, good. Great. Well, yeah, man. Let's get into it. I'm excited. First podcast of the year. So let's go.
Well, I think this one probably is best for you to kick it off. Everybody here cares a lot about the real estate market. Obviously, cares a lot about the mortgage market as well. But the real estate market really started declining considerably in mid 2022, and it was mortgage rates that did that. So do you mind, sharing what did we see in 2023 in the mortgage market? What happened?
Well, it got bad. Rates, everybody thought going into last year, rates were going to be significantly better. They were not. We bottomed in February, the beginning of February, at 5.99, and everybody got really excited. I know I did, and all of that. And then rates really they started to tick up. We talk a lot about. I'm just pulling some charts up here.
Sure.
We talk a lot about the 10-year Treasury and the spreads between that. I want to share my screen just so I can show y'all some stuff here.
Great.
Let me make sure I do this right. Share. There we go. Perfect. Okay.
There we go.
So this is the 10-year Treasury, and this is kind of going back, really back to February of 2023, kind of right here where we started to bottom, and you can see in October that's where we really started to peak around 5%.
So sorry to cut you off for a sec, but so this is the 10-year Treasury, and can you explain the relationship between the 10-year Treasury and mortgage rates?
Yeah, so that's where I'm going. There's always this. If any of you follow Logan Motoshami, he likes to call it the dance between the 10-year and the 30-year fixed. But that spread between the 10-year Treasury and the 30-year fixed rate historically is around 1.75 to 2 points.
Okay.
So back in COVID when the 10-year was at zero, rates were, half a point. Rates were about 2.5%. Really, about May of 22, we started seeing these spreads widen. Why? Because the Fed stopped buying and started running off the balance sheet, stopped buying as much in mortgage-backed securities and treasuries, all of those things, which caused this spread to widen. So now we've gotten to this point where the spread between the 10-year Treasury and the 30-year fixed rate is closer to 2.75 to 3 points. At some point, and I do think that that's going to happen this year, we will start to see that spread narrow. But what happened last year, we were kind of at this bottom here, and things were looking pretty good, and then we shot up. So I've got this other screen as well that I can share. It's not my favorite. I can't do a candle graph, but you get the idea. I mean, this is where the 30-year rate was on the, flip this here. on the this is a weekly basis.
Okay.
You can see last week, and this is the Freddie Mac average rate. Typically, this has about a half to 3/4 of a point in it, but you can kind of see where it is. So last week it was 6.6, but you come back to February of 23, which is right about here, and you see the average rate was up here 6.1, about 6.12. So rates just continued to get worse, and if you look on the left, as rates are getting worse, the 10-year's climbing. So that, in a nutshell, kind of went the opposite way of what we thought. As lenders, we always preached rates follow inflation, rates follow inflation, rates follow inflation. That didn't really happen because the rate of inflation came down. In June, July of 22, we were around 9%. And then last year, it's closer to 3.5%, 4% around that time. The issue is rates should have been higher in 22 than they were. And so we were kind of playing catch up. And these last 2 years, really, when you look at from a volume perspective and a transaction perspective, at least on the mortgage side, we did about 8 to 10 years worth of business in 2 years. And so that's got to correct itself and come down. So far this year, and really back starting December 12th, 13th is when we saw that initial drop in rates. And we've really been maintaining under 7%. For those of y'all that listen to me often, I like to follow Mortgage News Daily. And this really shows you kind of the average rate on a daily basis. And you can see we've kind of started to tick back up a little bit down from our lows. But just like anything, there was such a massive move down. Nothing moves in a straight line, and there's always corrective patterns that evolve. What I'm keeping my eye on right now on this 10-year Treasury, and let me just flip back over here, what I'm really keeping my eye on from the daily level is this level that we're at right now. This 4.15 level is pretty key. You can see this red line here is the 50 EMA exponential moving average, and we really want to try to stay under that. We've come up here and we've stayed under 1, 2, 3, 4. We're on the 5th day kind of here. Last Friday we spiked over it, but we actually closed underneath, so that was good. So as long as we stay under here, I think we'll start to see a little bit more downward pressure. And we've got another pivot point down here about 3.786. So that'll be good for rates. So this is something that I'm keeping an eye on daily and something that we'll want to watch moving forward into this year.
Right. So great synopsis. Question for you. You said that typically rates follow inflation. So when inflation drops, rates drop. I've always been under the understanding that, rates they'll follow the 10-year Treasury note, obviously, which is following inflation, but that generally follows, the Fed rate. Does it typically follow? Does the 10-year T-note typically follow the Fed rate? I'm sorry, typically follow inflation down because the Fed typically eases whenever inflation goes down. Is that why? It
can. Really, this all comes down to what are bonds pricing at, right? And what are expectations? When you look at mortgage rates specifically, one of the worst things as a lender is when the Fed does start cutting rates, immediately everybody thinks mortgage rates are better, right? And that's just not true. Mortgage rates are going to move based on what the Fed says is going to happen, right? The Fed does not control mortgage rates, but how does the market look at what the Fed's saying and what the Fed's doing? Right now, part of the reason rates are getting worse is because the expectation of rate cuts happening in March are getting less and less. The Fed came out last year and said rates, we're going to cut rates 3 times next year. But the market heard 6 times.
Right.
And the market is not listening to the Fed. And the one thing that I can promise you is the Fed does not play. Right. They have shown a history of when they say they're going to do something, they do it. They're not really deviating from their plan. I stopped sharing my screen. I want to show you this because this is super interesting to me. Let me get back here. So this is the CME FedWatch, and when you look at it,
right,
these everything in blue is expecting a rate cut. There was the expectation of a rate cut in March, and now you can see it's really closer to May.
It's really
And
funny.
then
I had that same screen pulled up while you were talking to see when it had adjusted, and it was something like an 80% consensus of the Fed cutting rates. This was like 3 weeks ago. 80% consensus they were going to start cutting in March. As you said, that seemed really optimistic. I will say this, mortgage rates staying sub 7 seems to me that's kind of what we need. I'm happy to see that the rates are sub 7 with the expectation with the market expecting rate cuts in May, if that makes sense.
Yeah.
Do you think we'll stay sub 7 into Q1?
I do. Yeah, I really do. I mean, we're kind of approaching there. But the other thing to realize too is when we talk about everybody's got a different metric. So you look at the Freddie Mac weekly average versus Mortgage News daily average. They're all a little bit different versus MBS weekly surveys that get put out. They're all a little bit different in the metrics that they use. I personally like Mortgage News Daily the best. A,
Right.
because it's daily. B, they're very consistent. It's a 780 credit. It's an owner-occupied 780 credit score, 25% down, basically with a point. So that's a really good way to track it. And I think as long as that's the measure, I do think that staying under 7 is really likely.
Right.
There's a lot of people forecasting rates the average rate getting down to the low 6. Fannie Mae actually put out a deal just the other day. They revised their expectations to drop below 6 by the end of the year. Does it happen? Does it not? I think as long as we stay in the 6s, life is going to be okay.
Right.
Consumers are very much aware of where rates are. The idea that rates are going to jump another point this year, I just don't think that's going to happen.
I mean,
I think
that would take an event, right? I mean, the Fed would have to start raising again. I mean, they'd have to get really hawkish for that to happen.
Yeah. And so, I feel like we've already started seeing the signs, even in through December. From a closings perspective, November last year was the worst. Most loan officers I talked to, both at Loan People and elsewhere, had an abysmal November. I mean, it was terrible. But applications kind of started picking up a little bit. And it all makes sense because rates, peaked in October. And you love to talk about leading indicators,
Right.
Higher rates, lower applications. That translates to 30 days down the road. So, as we've come in through December and into January, and some of y'all have heard me say this before, but, from an applications perspective, MBA or MBS rather, MBA, I just saw was up, about 34% month over month over the last 4 weeks. We've actually been doing a little bit better. We're up as a company about 60% over December, and even from January of last year, we're up about 10% on new applications, new leads.
Well,
but contract locks are up, volumes up, our pipeline's larger than it was. So all of those things we're really seeing a lot of good momentum.
Yeah. So, and I think that there are 3 things that will come into play in any market recovery, and that'll be, jobs. We need to see jobs come back, mortgage rates, which we discuss constantly, and then pent-up demand, right? So, people generally move because of life events, and with the exception of jobs, life events don't stop whenever the economy declines. People still get married, they still have babies, kids still move out of the house, things like that. When rates are not good, it's very easy to delay that move because of that life event, but that life event continues to apply pressure. So if rates don't go up this year, we will see some pent-up demand return. If rates, drop some, we'll see even more. If they drop precipitously, then we'll see a ton. But those life events are what really drive. And this pent-up demand, I think, is what you're seeing, and it's what we're seeing as well. We are seeing a big uptick in inbound calls, inbound inquiries, things like that. Right now, it bodes really well for the spring. And we'll talk about the election later. But from a strategy perspective, I think it makes a lot of sense to and I don't really want to go into it too deeply, but make hay right now, because I do think we're going to see a decline in demand as we get into the election. So
yeah, we'll see. And we'll talk about that here in a bit. But I mean, it's what I am curious about, and you and I haven't really talked about it. But when I talk to a lot of agents, you go back to October, November, December, people wanting to list their house, and generally people don't want you. Listing agents say don't list your house till the spring. That's that's going to be better than going January, February. But it does seem to me, in talking to a lot of different agents, that there's a massive amount of inventory that's about to hit the market in February, mid and February into beginning of March. And I think a lot of the idea was people thinking rates might be sub 6 by then. And I don't know that that's really going to be the case. So I'm curious, what do you think happens? Do you see all that inventory still hitting? And what do you think that does from a buyers versus sellers type market with rates where they are?
Yeah, so you have to understand that demand and supply are two separate components that interact and create pricing, right? So the demand is what we're talking about right now, and I do think demand increases if we have flat or declining mortgage rates. If we have pent-up demand coming back in, and then jobs, which we'll talk about in a bit. Supply side is something that's interesting. It's harder to predict. How many of these folks that failed in 2023 will try again in 2024? Some of them, I don't know the number. It'd be interesting to try to crunch it. Some of them converted to landlord. They converted to becoming a landlord, right? A lot of these folks that don't have that much pressure, you become a landlord when you have to, when you can't sell for whatever price you need or want. You say, fine, we'll kick the can down the road and we're going to rent this out. So those are off the market for at least a year. So they won't come back, and they won't come back in 2024. Wheels are turning right now. We actually could crunch the database and figure out how many of those has happened. And man, probably will do that. But no, it's those that chose not to sell in 2023. And I say chose because it is a choice, right? You can sell any property whenever you want to. It's literally price and time, right? So I don't know how many of them come back. You assume a lot of them do. You could probably make some educated guesses and say 80%, 90%, something like that. And I think that you can assume that that will be the excess inventory that we had in 2023. You can just look at it and say, okay, we had this many units come on. We probably are going to have this many units come on in excess this next year. How that balances out with demand, I'm not sure. How that works out, that affects the consumer more than anything, because that's what's going to drive price. And my intuition tells me that we're not going to see a lot of price movement in 2024. If we see any, it probably will be up just a little bit. It bodes really well for industry professionals, though, because if there is more inventory on the market, and there are willing buyers in the market that can find what they want, then there will be more deals. And ultimately, since we're speaking to mostly industry professionals here, the market in 2023 really kicked everybody's ass. Didn't do a whole lot at the consumer, right? Pricing didn't move just a whole lot. We were affected, pretty dramatically.
Yep. Well, and what's interesting too, we're seeing a lot of consumers on that perspective that were waiting for rates to come down.
Right.
Rates to come down. I'm going to wait till they're in the 4s. I'm going to wait till they're in the 5s. They're starting to come out and realizing like this is kind of where rates are,
right.
And maybe they get a little bit lower, maybe not. But everybody's really gotten used to that. So I think that bodes well as far as life events go. I talked to a friend yesterday who was thinking about moving. They're commuting an hour, and they were thinking about moving last year and just didn't pull the trigger because rates. And now they're like, we don't have a choice. Like there's more kids in the house now. Like they don't have a choice. They have to. And I think there's going to be, people waiting because of rates can only last so long, to your point, and you're not going to outrun life events. So
Exactly.
I think that bodes well for us here.
Yeah, it's interesting. We talk a lot about ninja selling, and that actually is not the whole like rate thing, but that's an example that Larry Kendall talks about in his book about a dad at soccer practice that told him he was, just got a new job that was 30 minutes away, and he said, "Oh, mental note, this guy's going to move in the next 6 to 12 months." Commutes are terrible, and if you're used to a short commute, it's a pretty impactful thing to all of a sudden have a long commute. How much is that worth to you? It becomes worth more and more in the opposite direction. Like you're willing to pay more to have a decent commute the longer you're making that commute. You think about it every day. It's an excellent example, man. So
yep.
So going back to what happened in 2023, it's important to differentiate what happened to the consumer and what happened to the industry professional. And it's very important for us that whenever we communicate messaging to the consumer that we don't allow our own feelings and biases to tell people like, hey, the market's terrible, things like that. There's certainly decreased demand, no question about it. But there was a lot less supply, a lot lower supply in 2023. And we sent a newsletter out this morning, consumer facing, a lot of industry guys also get, that showed that if you look at the average in 2022, average price, and the average price in 2023, it dropped something like 8%, right? And that's not a ton. In the grand scheme of things, that's about a year and a half of appreciation in Austin. Consumers care about, can I sell my house and how long will it take? And certainly it took longer to sell your house. But if the messaging to the consumer is that, hey, the market's absolutely awful, that's not true from their perspective. Average 2022 to 2023, it dropped only 8%. And I'll pull up the Jan to December numbers in just a second, and I can tell you guys what that looks like. It's even rosier whenever you look at where was the market in January of 2023 and where did it finish in December of 2023. And I think it was almost flat. So let me look at that really quickly. Are you seeing a lot of sellers, buyers, people that are moving up choose not to move because of their value or anything like that?
No, that's not really anything that I'm seeing or hearing. Value's not really a thing. It's it's life events. This just needs to happen. If anything, there are more and more people realizing that you're getting a better deal today than you're going to get 12, 18, 24 months from now.
Right.
And, we all started, the whole industry, lenders, realtors, anybody with the pulse, date the house or date the rate, marry the house, got put out there. And, I think we all overdid it a little bit with that, but consumers really are starting to see like, okay, this is going to happen. So let me get this better price now. And you're still seeing, at least on our end, I'm sure on yours too, sellers they're paying. I mean, they're paying closing costs. They're permanent buy downs, temporary buy downs. Also, like, people can negotiate. It really reminds me of, 2007, 2008, 2009. Even still in that perspective a little bit.
Yeah. It's interesting. I follow a lot of meme accounts, and there's some of these real estate memes are like, how can it always be a great time to buy? Because it does sound like a sales pitch whenever you tell folks like, no, it's a buying opportunity. But genuinely, it is a buying opportunity. Now, those memes, there's usually a lot of truth to them. It's really hard for it to be both a great time to buy and a great time to sell. I mean, you got a pretty balanced market. It's like, hey, it's pretty okay time to do either one of those. I would say certainly it's in the buyer's favor right now. So, if you need to sell, you can still succeed. You're still going to get fair market value for it, which if you look from 2019 to 2023, where we are today, that's 46% increase in value. So you're still doing great on not even a long-term perspective. That's a 4-year perspective. But you might have a bit of a difficult time. You're going to have to give some concessions up. Look at it in terms of what was my overall return on investment. If you look at it from that perspective, you're going to be very, very happy. You've been in mortgage in Austin for a long time. I've been in real estate in Austin for a long time. If you look at it on a long-term perspective, it's very hard not to be just incredibly bullish on Austin. And, I think that we will look back in not even 5 years. I think we'll look back in 2 or 3 years and say, wow, 2023 and 2024, 2024 was a great buying opportunity. 2023, like, wow, if you had a crystal ball, like, you should have bought everything. I always say that about 2009. I had a feeling in my gut, like, this is a really good buying opportunity. There were duplexes in Northwest Hills that were trading at $250,000. And I remember, I was looking at those going like, wow, these were selling, people were condo converting them and selling them for $250,000 a side 2 years before. And you looked at it and said, intuitively, this is a really, really good time to buy, but it's also very scary whenever the economy's in free fall like it was. I think we will see, the start of the recovery, if not like probably a very firm recovery in 2024. And that's the smart time to buy whenever you're no longer going down, you're on the upswing, you're going to pay a little bit more than you did the previous year, but you have that security, the sense of, hey, this is a very smart decision. I'll trade that. I would happily pay 5% more for something and know that it's not going to decline in value any day of the week versus try to time it perfectly.
Oh, yeah. Well, you never time it perfectly.
Right.
That's when you get burned.
Right. Yeah. You have to understand. I mean, timing things perfectly, it involves way more luck than it does intelligence. And if you think, yeah, you look around the room, and if you can't find the sucker, you're the sucker. Like, if you feel like you're the smartest guy in the room, you're probably not. If you feel like it was due to your intelligence that you timed this perfectly, like, you're not going to time the next thing perfectly. No chance. So
that's right.
Yeah. So to go back to it, from an agent and a LO's perspective, talk about that for a second. And this is where, my optimism kind of starts to come down a little bit, or at least my rosy outlook comes down a bit. And, whenever we were looking at the market from the consumer's perspective throughout last year, which we did most of the time, it didn't really reconcile with what we talked about with agents and loan officers, because talking with agents and LOs, man, it was bad. Nobody's selling anything. And I ran some numbers, and this is where, I can tend to get lost in the numbers a little bit. So I'll try to simplify as much as possible. Units sold were really bad, right? And if you started the business in 2019, 2020, and your perspective was 2020, 2021, units sold were absolutely horrible. They were down 25% from 2021. So 2023 to 2021, if that's your basis of comparison, there were 11,000 fewer sales. Then, okay, great. That's fine and dandy. 2021 wasn't a normal year. Let's say you accept that. Well, let's compare it with 2019, which I think we would all agree was a normal year. Units sold were still down 17%. So almost a fifth fewer sales. And that's why, nobody felt busy, was because there were a lot fewer sales. It makes perfect sense whenever you look at the, economic fundamentals. But it still doesn't feel very good. Max, it's funny, you and I are now like the old guard that talks about, well, back in when I started, I remember agents would always talk about the early 80s. Do you remember that? In LOs? Well, we had 15% interest in the late 70s, early 80s. And you're like,
we drove around with the roller quarters in our car so we could stop at a payphone, all of that stuff.
Right, stuff like that. So now you and I are talking about 08 in the same way that the old timers talked about the early 80s. And we always use 2008 as sort of our benchmark of awfulness, right? That was and in hindsight, not to deviate too much, I feel like it was so bad because it lasted so long. It was 08 to effectively 2012 is whenever we saw the recovery, and that's a 4-year period. Mm-hmm. And man, it just beats you down if you're trying to slog through that. So anyways, I went back to 2008. Somebody commented on Facebook and said, I heard that November of 2023 was actually worse in terms of units sold than November of 2008. Looked it up. That wasn't the case. But I said, look, this doesn't jive because the numbers didn't go up as much as they should have. Austin's population grew really considerably in that amount of time. And the population grew from 2008 to 2023. It went from 1.6 million, and the projected population in 2023 is going to be 2.49, so just under 2.5 million, so almost a million people. And I crunched the numbers, and if you adjust the units for population growth, there was actually a 9.5% decline. So the number of sales per person in the city or in the metro went down 9.5%. A lot of other assumptions you have to make here, like that the number of agents went up by the same amount, whatnot, that are probably safe assumptions. But looking at it like, hey, the number of sales were really bad. When I said that, I know I told you this a few weeks ago. What was your reaction to that?
I mean, it felt like it. Yeah. It felt like it. And I think it's even exacerbated more on the lending side because, as loan officers, you have purchase deals and you have refi deals. But refis, rates are 7-8%. They're basically gone. 80% of the world has a mortgage rate under 6%. So in addition to sales being down, refis are completely gone. Some loan officers are, 60, 70, 80% refi. They're probably out of the business. And when you talk about loan officers leaving the business, that's generally who left. Those of us that are primarily purchase business are here and will be here and thrive. But and generally the average loan officer is somewhere around 20% refi. So you just take 20% off the top and then you cut your purchase business back. It was really bad.
Right. Yeah. And I want to bring up margin compression in a second as well. And I know that the LOs that are listening will understand that, but a lot of real estate agents don't understand that. I know I certainly didn't understand how impactful it was until this year, because you and I discussed it so much. So I'll dig into the numbers just a little bit more. So units sold were terrible. It was, hey, we're not, we are less busy now than we were in 2008, the great financial crisis, in terms of how many homes we're selling. But agents are very fortunate in that, our compensation is relatively pegged to the purchase price. And granted, there can be some movement on buyer's agent compensation, and listing agents do negotiate things like that. But generally speaking, personally, I always work at 3% on the buy side and between 2.5% and 3% on the sell side, depending, right? So we're going to get the same amount of money most of the time. And if you look at the overall volume, meaning the dollar amount traded in 2023 versus 2008, it was actually, if you adjust for population, again, it was almost 2.5 times. And the reason for that is that the average purchase price went from $243,000 in 2008 and is $575,000 in 2023. So the purchase price went up very considerably. Units dropped by almost 10%, but the net result was a volume increase of almost 2.5 times. So, 136% increase. So agents' paychecks didn't take that big of a cut. Now the morale took a huge cut. And in terms of anxiety, that took a massive, massive increase. But the paychecks are much higher now than they were. I mean, the overall pie is much higher now than it was in 2008. And that's important to remember. And we'll talk about opportunity in a bit. And the opportunity really lies in others going out of business and others doing poorly, which, God bless them. But, we'll try to take advantage. We'll try to take advantage of that. But on the mortgage side, I mean, do you think bloodbath is too strong of a word or no?
No. I mean, coming into October, November, December at the conferences and everything, where I'm going, where owner operators are and all of that, it was nuclear winter was the term for what was upcoming. I mean, and it was really bad. Volume fell so much on all fronts. At this point, everybody's just trying to do a loan for what they can. And you have companies, like, it came down to who's willing to either make the least amount of money on a deal or who's willing to lose the most amount of money on a deal. So you take that coupled with the fact, once a mortgage bank, broker, whomever originates a loan, they're doing something with that loan. They're selling it to Fannie Mae, Freddie Mac, Ginnie Mae, maybe an aggregator, which would be, a Chase or a Wells or whomever it is. So there's value in the loan. There's value in the servicing. Well, because rates were so high, there was no servicing value. So you can't even get any sort of premium when you go to sell this loan. So what did we see? Companies losing money left. The majority of mortgage companies lost money last year.
Right.
And I'm very vocal about it. We did too. I've shared with our company the financials, and we're super solvent and we're fine, but we lost money.
Right.
Companies that didn't lose money were able to do so because they have these very large servicing portfolios that helped overcome that. Now, we're fortunate that we now have our Fannie Freddie servicing approval, and we're working on doing that. So the next time this thing comes around, we'll have a servicing portfolio, and that's great. But what you saw from a company perspective and a loan officer perspective was massive cuts, a lot of part in commission. So you have loan officers that took big cuts in commission and made significantly less money than they even made in some cases, loan officers made less than they made in 2010, 2012.
Right.
It was really bad. And you've seen a ton of mortgage companies go out of business. And we're not out of the woods yet as an industry. We still need to get really through Q1 and probably even Q2 for a lot of these companies. And you're about to see a lot of companies, still small companies, that aren't going to make it. So when we talk about opportunity, for loan people and companies like mine, the opportunity is to acquire some of these companies or their loan officers that they can't make it. They don't have much money left. They're not going to be able to outrun their burn rate. What we have seen in the last 4 to 6 weeks is margin compression there's some relief to it. It's by no means where the industry wants it to be, but it is getting better. So I am hopeful that we'll see things hopefully normalize, maybe in the next 3 to 6 months. But to put it in perspective, from a percentage wise, I mean, if you look at from a real estate agent perspective, think about cutting your income anywhere between 25 and 75%, but still having to do the same amount of work, if not more, because everything's so much more difficult. And that's really what loan officers have been dealing with for the last year to year and a half.
Well, so I will say, I think the paycheck on the real estate side went down by about 20% on average. That's the size of the pie. This is versus 2022. Yep. And in terms of working harder, certainly, whenever you look at, I think average days on market finished at around 80 at the end of the year last year. And again, 2021, not a normal year, but average days on market were 20, and that's 4 times the amount of time to sell. And that comes to fruition on the buy side and the sell side. Your relationships with your sellers are much longer, more stress is involved. Buyers, thankfully, have more to choose from, but there's no urgency. I've been in what I would consider a perfect market, a handful of times in my career where, generally speaking, it takes 3 or 4 weeks to sell a house. Buyers have properties to choose from, but there's enough urgency involved that they're ready to pull the trigger whenever they see something, and you don't get that equilibrium, very often. But it's pretty out of whack right now. The days on market are really long, so it does take a lot longer. And you see, because of the amount of stress that's involved, there's more lawsuits. There's more crazy things that happen. You have to deal with difficult personalities a lot more. So it was a really stressful year all around. I will say, who got the brunt of it? Who got the worst end of the stick here? And that's certainly LOs, because if we took a 20% haircut on our paycheck and you guys are between 25 and 75, well, that's obviously worse. So
right. Shout out to Chris Jacobs. I would see him post on Facebook, "Give your loan officer a hug today."
Well, Max,
last year.
I send you virtual hugs every day, so I didn't need that reminder. So
yeah. So
yeah. So go ahead.
I think I was just gonna say, so we know it was bad, we know what it was, but there's light at the end of the tunnel. One of the sayings we have around here is there's light at the end of the tunnel, and we can tell it's not a train coming at us. Right. I am very optimistic about this year and what it holds for my company, for our industry, for our city. I feel like the worst is really, really behind us. 2024 is going to be good. It's not going to be amazing. It's going to be good, and it's going to be better than what it was. And we've got good momentum.
It's all perspective too. So, whenever your perspective was 2021, and then, call it May, June 2022 hit, it was, oh my gosh, we just went from this absolutely insane market, and now we're in a market that feels like it went to a screeching halt, right? Well, things were still selling, things were still trading. It just wasn't at that insane pace that we had in 2021. Now we're coming off of a really, really slow market in terms of units sold, and we're going to see that tick up. I don't think it will get back to 2019 levels this year. I do think it'll return to 2019 levels in 25 or 26, maybe 2018 levels in 25, maybe 2019. But those were very good years. I will trade a 2019 for a 2021 any day of the week, because it was just a more pleasant environment in which to work in. To go back,
I like to say I'll give it all up for 5 2018s just to have some. I wasn't this gray,
right? Yeah, it's. I'm looking forward to it. I know I talk about this a lot, but I have very, very fond memories of 2013 and 2014. Granted, that's when our company, started really growing. But the really fun part was when we came out of the recession. All of the unsuccessful agents and LOs went out of business, and there was a short period of time before everybody rushed back into the market to sell. To be an agent or be an LO, and we knew everybody, and it was great. I would say we had far fewer crazy deals at that point in time because the agents were so competent back then.
Mm-hmm. Yeah.
So to jump in, I know we've definitely expressed some market predictions for 2024, and when you discussed CME FedWatch a minute ago, let's dig into the numbers and why you and I are bullish on cautiously bullish, cautiously optimistic on 2024. And if you don't mind, I'll discuss FedWatch to start, and then if you want to discuss mortgage, because that's obviously your expertise. So I'll share my screen really quickly, and this is what Max shared just a moment ago. And if you guys are not familiar with CME FedWatch, it's a great tool to become familiar with. I learned of it, call it 3-4 months ago, and I won't shut up about it anymore. So what it does, and I look at these tabs across the top. I'm a simple guy, and it's a little bit easier. So what they do is they have predictions for the Fed rate announcement for every upcoming meeting. It looks, I think it's a 12-month prediction. And it's obviously going to become less reliable the further out you predict. So January 31st, a week from now, 97% consensus that the Fed is going to hold. They won't reduce rates. They won't increase them. This is the March tab that Max mentioned earlier, and it's one that moved. If you looked at this 2-3 weeks ago, 80% consensus that the Fed was going to reduce rates. There was actually, I think it was like 18% that thought they were going to drop it a full half point. That's obviously changed. There's now a majority consensus that they're going to hold in March. Personally, I think that's a good thing that's now the consensus, because I think things were a bit too bullish in the market before. They were pricing in too many cuts. So the consensus is now that May 2024 is 52%. Believe it'll be, they'll drop it a quarter point. 1/3 thinks they'll drop it a half point. And then I won't cycle through every single tab here, but you can go through and see what the predictions are as you go through the year. So more than likely the market's correct. More than likely the experts are correct, and they will start lowering rates in 2024. We all understand that there's a relatively direct correlation between the Fed rate and mortgage rates, and Max, I will now kick it over to you. What are your predictions for mortgage rates, which we talked about a little bit ago? But what do you think is going to happen in Q1? I mean, if you're brave enough to break it down, either quarterly or even the first half of the year, second half of the year, and we all understand. I'll go ahead and give the disclaimer for Max that anytime you pull out your crystal ball, you can be wrong. This is just his sort of expert opinion that he is basing his decisions from.
Well, I'll say this. I can confidently say, guaranteed, rates are going to do one of three things.
Right.
That is guaranteed. Get worse, get better, or stay the same.
Right.
I do think that rates are going to come down this year. I think, like I said before, Q1 we're about in the range. I don't see that average rate moving significantly downward. I do think we're at the top of the range for that, but the idea that rates are going to be in the fives Q1, even Q2, I don't think so. I mean, I think that I think we're about here, high sixes Q1, mid sixes Q2, maybe low sixes Q3, and who knows. So it's a very straight. It's this whole year. We're definitely in uncharted territory, and we have been, but there's a couple of things. One, inflation's coming down. Inflation's getting under control. Like that is a good thing. We are in an election year, and historically, when you look, rates do come down in an election year. So that we've got that going for us. And again, everything moved so drastically, so fast upward. You've got to have a correction. I mean, it's inevitable. So that's in a nutshell. That's kind of where I see things.
I think you're absolutely correct. And quite honestly, you look at what's the Fed's goal, and their goal the stated goal was to reduce inflation, right? They're there. And then they've, this fuzzy word, soft landing is what they're trying to accomplish. It would not be a soft landing if they guided the mortgage market into the fives in the spring of 2024. At that point in time, you have a very, very V-shaped rebound because it will, whatever they do is going to affect the broader economy. They really don't want to whipsaw, and quite honestly, I don't either. I would hate to operate in an environment where, 1 year you have a screaming hot 2021, and then the next year you have a 2022, 2023, and then you're back to screaming hot. I think that a nice, steady recovery is their goal. And I mean, I don't think that they've stated that, right? So I agree with you wholeheartedly. I think that mortgage rates will, not drop into the fives. And frankly, I don't want that.
Yeah. Well, I'll say this. I mean, they're obviously what I say in public and what I say in private sometimes are different things. I don't want to be overly optimistic and give people the wrong idea. I could certainly make a case where rates are in the fives
right
by Q2, Q3. I don't know that we get this soft landing. When I look at when all these employment numbers come out, you go back and look, jobs aren't as good as they seem, especially on these original numbers. You go back and look at every report that's come out since July and maybe even before, the revisions, they revised them downward, and they're significantly worse.
Well,
and if those were the numbers that came out initially, things wouldn't have gotten where they were. And I think they're going to continue. So even when you look at the ADP and everything that came out, last week, it was everything beat expectations by a lot, and the market didn't flinch. Basically, the market said, yeah, right. Let's wait for the revisions. And so I think that, that does play into our favor. Bad economic news, higher unemployment, all that is, unfortunately, for the people stuck in that realm, that is good for mortgage rates. There's a scenario where a lot of things can happen, but
and it's interesting you bring up jobs. That's a major component of Austin's real estate market. It's a major component of the broader real estate market. And the numbers, the unemployment rate does not accurately reflect the jobs experience in Austin. I mean, we made some hires in early 2022, and then made hires again in late 2023. Wildly different experience as an employer. Job market was incredibly tight in early 2022. It was much more employer friendly whenever we made hires in 2023. I mean, salary was down, number of applicants was way up, and you can quantify this. And I was very happy to find the data on Indeed.com, which I think everybody would agree has a ton of data, and they make it available, and they make it available market specific, and their numbers are down. They're the number of job postings on Indeed in the Austin metro is down roughly 25%, depending on the month, versus the previous year. LinkedIn, I recently found, they also issue employment reports. There's a lot of hiring that's done on LinkedIn as well, and they don't issue reports that are market specific, but they do issue reports that are industry specific. Don't quote me on this, but I think something like the tech industry, I believe, was down 26% year over year. The hiring was. And whenever you talk with friends, colleagues, whatnot that are in the tech industry or that are looking for jobs in Austin, that's the experience that you hear. What that calculates to is that job security doesn't feel as good. So if you're considering moving up, you might hold off because there's not a lot of hiring out there. And even though you might know that you do a wonderful job, there's always that thought in the back of your mind that what if I get fired? And if you get fired, it's not a great job market, right? So that causes people to hold off moving due to these life events. So that's the component that we're looking for. I think that the writing is on the wall for mortgages. I think the mortgage rates will decline down to the low sixes or high fives, depending, by the end of next year. We need to see hiring come back. Since I've worked in Austin, since you've worked in Austin, how many reloads do you do every year normally? I mean,
I don't know. It's not really a measure that we tracked.
Right.
What I do know, and we talked about this just in COVID, it was very interesting. It got to the point more so than ever with everybody moving from California, Florida, where for the first time I could think of, we had to specify, are we talking the time that we're going to have a meeting? Is it Central Time? Is it West Coast? Is it, so other than that, it's just not something we've really tracked.
As long as I can remember, I've known that the San Francisco area code is 480. And the reason I know that is because whenever that area code rings, you pick it up,
It's not the Ludacris song.
And I can't rattle off all the area codes, but I can tell you this: if you flash a bunch of area codes in front of me, I can tell you whether to answer the phone or not. That's coming from an expensive market. Answer the phone. Don't not
That's
answer
right.
the others. But coming from Dallas, maybe not. So.
You're right. Right. Um, one thing that one measure that, and I don't know if I've even told you this, but some of our mutual friends and I talk about this. One of my metrics as to what's going on, there's a McDonald's right here at Mopac
Yes.
in 22-22. And at one point, their starting wage was like $25 an hour. And then we watched it come down to 21 and then 18. And right now, if you drive by there today, it's $13 an hour is what they're now
Is it
hiring.
down to
So
that? Wow.
yeah,
Yeah.
yeah,
I
yeah, yeah.
always use that as a different example on like how, you can't hire anyone at minimum wage, at like the actual minimum wage in Austin. But yeah, it's funny. I think
Oh,
you and I drive by that same McDonald's all the time, and I have noticed that as well. I didn't realize it got
yeah.
above the 20s. So,
Yeah.
but
Sitting at 13 right now. So
yeah, but to go back to it, I mean, we need to see hiring come back. We need to see good jobs come back. Oh, I'll tell one other story, right? A few years ago when Beck started going to DOS, one of the kids he's friends with, his dad actually worked at Indeed. And I have a past client and friend who has worked at Indeed for a long time. I said, hey, do you know this guy? He said, no, but I'm gonna go look for him. And he had just started working, Jim had just started working for Indeed. And then I saw him again a few months later, and I said, hey, did you ever find Justin? And he said, oh, no, I don't work there anymore. I ended up moving over to, some other company. Well, why would you do that? You do that because you get a better offer, you get a better salary. Whenever those events happen, very easy to decide to buy a nicer house. Whenever those events are not happening, harder to decide to buy a nicer house. So the lack of hiring, the lack of these good jobs in the tech sector, it directly affects us from top to bottom. I mean, down to the executives that are moving into Central Austin and buying $2 or $3 million houses, things like that, all the way to the really well-paid programmers that are living in Northwest Austin. They're just not moving in. They're not getting better jobs. And so that will come back. There's no way that these tech companies will stop relocating people here. It's still a very, very smart financial decision for them to do so. They've built a ton of offices here. It's just a matter of when, really. And
yeah,
when we see that start to happen, we will know there's call it 3 to 6 month lead time before the market's really going to take off. Again. So I'm excited for that. So
I am too.
Yeah. So the election, we haven't discussed this a whole lot, other than the fact that we both hate it. How do you think November and the closer we get to November will affect the real estate market in terms of buyer demand?
I think you and I are a little bit different on this. And I mean, you have more insight on the actual real estate side of it. I don't know that the election, my personal opinion is, I don't know that it really does much to actual demand from do I want to buy or sell real estate. I think it's just, it's another event in our world that happens every 4 years. And that's that. What I do think is historically rates get better in an election year. And, all signs keep pointing to rates are going to get better this year. And obviously that's not just because it's an election, but, political pressures and things definitely can play into all of that. So I think overall, if rates do continue to come down and rates are somewhat to significantly better this year, I think that does impact demand. There's a question in here from Ben asking, at what point does market normalize again with rates 5-6% or what? I think that, and you talked about memes earlier. There's that one meme where the guy's running down the street and it says mortgage rates at 7%, and then someone else joins and it's mortgage rates at 6.5%, and then a few more people join and it's mortgage rates at 6%, and so on and so forth. I think if we see a 5 handle, I think that's going to drive a lot more demand. So that's really, we'll see what it does. Again, I think rates are going to be better. Do they get low enough to drive a lot more demand is the question. But I don't think that the election itself necessarily dictates, we're going to sell more houses or not.
So, yeah, I mean, the reason why I feel like, one, it's hard not to your morale to be affected by the news cycle, right? I've done everything I can to just opt out of the news because I don't think it's productive. But still, you see stuff come across your screen. And generally speaking, whenever you have two candidates campaigning, I don't care what you think about the candidates. I don't care about which election you are discussing. The challenger is trying to tell everyone how bad things are because they want to win. And so what that does is it causes consumer sentiment, consumer confidence to decline. And I have the Trading Economics consumer sentiment website pulled up, right? Or consumer confidence website pulled up, or sentiment, whatever, it doesn't matter. And I'm looking at 2020, and 2020 is a really weird year because it just dropped in March, April, and then it stayed pretty much low throughout the rest of the year. So we had a pandemic that caused that. I won't try to do this live, I don't think, but it would be interesting to look at 2016, 2012, 2008. I'm looking at 2016 right now, and I'll share screen really quickly. This isn't definitive by any means, but it's sort of the idea that I have. The poor news cycle tends to just beat things down. And you can see the year started low for some reason, went up, and then starts going down in October. Then there's the election, and it starts going back up as the news cycle kind of normalizes. That was a weird year too, because it was a year that, whatever you think of him, it's a year that Trump was elected, and there's a lot of strong concern, and I think that's why it bounced so heavily in November, whenever the world didn't literally end. But it'd be interesting, and I'll do that. I'll look into the numbers basically on the past election years. You certainly hear that anecdotally from most agents that, it's an election year and it's going to be slow because of that. People do tend to get, not everyone, but a percentage of people do tend to get consumed by the news cycle. And that's why I won't be surprised. Sorry to keep going on and on about this, but it also coincides with seasonality. So everybody's always surprised whenever demand, falls through the floor in August, September. Happens every year, right? The election's in November. What else is in November? The holidays, right? So you're going into the season where we generally don't sell a whole lot. I don't know if you're looking at what do you do actionably. I don't think it really changes anything. I think you say make hay while the sun shines. We know that's the busy, call it March through June is the busy time of the year anyways. You should probably try to sell as many houses as you possibly can. You should probably push your vacations back to October, November of that year. So.
Yep.
It's when ski season is anyways, Max. I don't know why anybody vacations anytime besides the slow time of the year. So
hey, what can I say? I've been skiing once, and when I go on vacation, I'm not really on vacation anymore. I'm addicted to work. What can I say? I do think it's important, and you and I didn't really talk about this, and I know we're kind of coming up on time, but I think it's important for everybody to remember 20, 21, 22 were super easy. You didn't have to do a whole lot. Second half of 22 and certainly all of 23 really put you to the test on what you had to do to be successful in this business. You and I talked at ABOR last year and pretty much all year to anybody that would listen. A successful year is still being in this business.
Right.
It didn't really matter how much you sold, how much you made. But it's extremely important that everybody remember the lessons that we learned in 2023 and the things that you did to generate business, to generate conversations, to get your name out there. Don't stop doing that. Keep all of that stuff in motion. It's there. I've seen some of it start to happen already with folks where, okay, things are getting busy now. I got to focus on this. Always do what works and don't stop just because it's working. Lean into it more. Whether you have to time block or get an assistant, whatever it is, don't stop doing the things that have helped you get business now, because that is how you will grow as we come out of where we were and move into the next chapter of this business. So,
yeah,
I think it's really, really important for people to remember that and keep that in mind and don't stop.
So what I feel like, when the market goes down, which it has, right, it forces you to become more efficient in a number of ways. So if you have a lot of expenses, it forces you to take a hard look at your expenses and to cut the wasteful stuff. It forces you to look at what's really effective and to do more of that if you want to stay in business. When the market is good, you can be sloppy. I'm not saying it makes you bad necessarily. You can be an amazing agent, an amazing LO, but you can certainly be sloppy. You can certainly waste a lot of time on things that are not effective, that are just fun, and convince yourself that that's work. But hopefully, like you said, hopefully everyone has learned some lessons in 2023 in terms of this is what really works for me. And what you and I talked about before, looking really hard at what does work for you is generally step one. And it always surprises me how few people take a hard analysis, take a hard look at that and really analyze. You and I interviewed Brittany Hodak, who's amazing. Love her to death, love her book. Mm-hmm. And, she absolutely gets it. I mean, for somebody to have laid it out so clearly is the only surprising thing about that, because it's pretty obvious to most business owners, and she just does a great job with it. And Max, you mentioned that the book is it's creating superfans, and it's something that if you haven't read it, I bought 15 of them the other day to give away. Yes, and hey, I will bind this. Unfortunately, only real estate agents in the Austin area. If you promise me you'll read it and you'll discuss it with me afterwards, I will buy you the book or the audiobook. Like, out there, just hit me up, Eric@Bramlett.me. I'm happy to do that. I just want to hear what you think of it, and we can chat about it. But back to it. Brittany was discussing. It was a tech company who was systematically tracking referrals for a relatively low cost good, right? And they had to have tracking codes on it and all this stuff, but people make impulse decisions when they do that stuff. So it's much easier to make those sales. And Max, you said, oh, well, we track all of that. We have to do it manually. It's impossible for you guys to do it with like a tracking code or anything like that. And it's impossible for any real estate agent to do that with a tracking code. You have to do it manually. And my insight was that, most real estate agents, if you're really doing well, you're going to close between 24 and 36 deals a year. And like good agents are generally between, one deal a month, 12 and 36. Doesn't mean those are the only good agents, but that's generally where it is. So let's call it on the high side. You have 36 deals you need to track every year and like look in a spreadsheet and see, how did I get those? Who referred them to me? Let's jump it up. Let's say you have 50 transactions you need to do that with. How long would that take you and Dana to code 50 transactions, do you think?
Not that long.
And here's the thing, and here was why I was like, oh wow. How many transactions do you guys code every single year?
Well, last year we probably coded, off the top of my head, 3,000.
That's right. And what was cool about it was that you thought it was a no-brainer. You said, well, one, it didn't take very much time. And I'm sure it took, a decent amount of time. I think that your reaction was it didn't take very much time whenever you compare it to the amount of value that we get out of it. I mean, how valuable?
Well, the thing is, you're a systems guy, you're a processes guy, right? Like, the thing is, what took a lot of time is setting up the system to be able to do that. But now, anytime a lead comes in, the loan officer is selecting the lead source, right, whether it's Yelp, Google, whatever, or who the agent is, or is it a repeat client? And so we've set up our systems to where it's one click. It's one click. So if you're doing that as the lead comes in, that makes it a lot easier. You don't have to sit down separately and go do 3,000 deals, 3,000 leads. It's as they come in, they're being coded either by the loan officer or by what we call the concierge team. But it takes no time to do that because everybody does it. And you have to talk to this person anyway. You have to take notes, right? So if you don't have a systematic way of keeping track of all of your leads, how they came in, notes, all of that, that's step one. But once you have that system in place, it's very easy to just tag it. And then, however, if you do it on an Excel sheet, make a pivot table.
Well, exactly. And I'm going to actually show an Excel sheet in a second. But whenever you and I talked the other day, I think it was a couple of days ago that we chatted about this. And, whenever our business took off, it was whenever we built Transactify, which was just a DA system. And I've always been obsessive about coding company leads because we take more revenue on the company leads. And that's whenever we looked at the end of the year and said, oh my gosh, well, we got X amount from this and Y amount from this. And like, we should invest more here, less here, things like that. After we got off the call, and I didn't mention this to you, where I felt like I had a big opportunity for growth was to start really encouraging the agents to do that on their personal deals. On the, I've always encouraged people to do that in terms of motivation, but I haven't really sort of given that extra push on every transaction. Oh, you just turned in a transaction and I saw you coded at this. Who was the referral source? And at the end of the year, you look at that and you go, oh, great. Well, Randy gave me 4 deals last year. I should probably take Randy out to lunch and buy him something nice, something like that. So that's something where I saw room for improvement based on our conversation. What we've done in the past, and what I would encourage every agent to do, is we floated to our agents. We said, hey, would you like for us to do a transaction analysis? I'm sorry, an income deal analysis for you? And we sent them a spreadsheet. We ended up with 6 agents. We analyzed 304 deals, and I'll share screen again just really quickly so everybody can kind of see what we came up with. And this is what we call our what works effort, and we'll do it again. So whenever the agents sent it over to me, I just cleaned it up. There were a lot of things that would say like referral, past client. Well, that's SOI. Both of them are. And there was no surprise that 43% were SOI whenever we looked at the least simple version of this. Then we simplified it even further. And when you simplify it even further, where you then add in like agent referrals, things like that into SOI, it became 49.3%. And then the simplest version, when we looked at it, it was 49.3% was SOI. Company provided leads at 36%. And by the way, we spend, 7 figures on company leads, and still SOI crushes it. And then everything else was 14.5%. So the very, very simple takeaway, which unfortunately is not that exciting, but it is, if you say, okay, I'm going to act on this, is that most of your business probably comes from SOI. And that's where you should probably focus most of your efforts. And Max, I used to joke that you built a massive business on cake balls, and it's not that simple, but you guys have done such a great job of segmenting your database and then, staying in touch and creating super fans of agents and past clients.
Yeah. No, thank you for that. It's definitely a huge passion of ours, which is, why I loved Brittany's book. You and I haven't even talked, but I did have the opportunity to meet her in person recently, and
awesome.
It was
I knew
it was
you were
awesome.
Going to. Yeah. Hope did you tell her I said hi? I hope
I did. Yeah, she was amazing. But the thing is like, and I talk about this a lot. SOI is super easy. Like when you go to the grocery store and you hear someone talking, do you say something? I walk around everywhere with Lone People gear on, right? And we give Lone People gear out to everybody, but everybody in my life knows what I do. Right. Everybody. I talk about it all the time. I live it. I breathe it. All the time. The lady that cuts my hair, if I go get my beard trimmed, whatever it is, everybody knows what I do. And that is one of the easiest things that a loan officer or realtor or any other person in a business can do. Does everybody in your world know, right? Like how many times does a realtor or a loan officer see that a friend or someone they went to high school with or whatever bought a house and like, well, why didn't they use me? A lot of times it's because they didn't even realize that that's what you do. They didn't think about you. You're not top of mind. And so there's a lot of just really easy things that you can do to just let everybody in your orbit know.
Right.
And I think that, there are people that get afraid to talk about outside of work, talk about work outside of work. But, I think it's always work. You're always like, yes, we all do this for a living and we all do this to make money. And no, we're not a nonprofit. But at the end of the day, if your goal is just to make money, then you'll do okay. But if your goal is to help people and you really are passionate about what you do, it's not work to talk about it. Right. How often do you and I just get on the phone and talk about it? Whatever it is, I enjoy it. It is, I can't believe I'm about to say this. It's relaxing to me. But that's, tell me about it. But even like we have friends that reach out to me all the time and they're like, hey, what are rates doing or what is going on? And they're not even in the business. They just want to know, and it's like, I can talk about this stuff all day long. I'm passionate about it. I love it. And, if other people, if you bring that energy and that passion to what you're doing, people are going to know. And again, that just comes back to your SOI and people just knowing like, okay, you're the go-to.
Right. Absolutely.
So,
Well, I'm excited about 2024. As excited about 2025. I do think that, last year was very hard. No question about it. I know that you approached it very intelligently, did what you had to do. I like to think that we did as well. And I'm very excited to start reaping some of those benefits in 2024. And it's not going to stop. It's something that we will, hopefully make even more gains in 24 and then
you
25.
cut out there, so I don't know if you're talking, but I agree. I'm very excited for this year. I'm excited for what's in store. The Loan People platform is honestly, man, it's better than ever. We're direct Fannie Freddie. We have our servicing approvals. We are we are a big boy mortgage company. Just like you, we're growing. We're ready to add folks and help take them to the next level. Like I'm very, very excited about everything that's coming our way, the industry way, your way. So here's to 2024.
Absolutely. We'll bro out for a second. It's been really neat to watch both of our businesses grow, on a relatively same timeline. I always joke. I mean, yours is. I always joke that we can just 3x whatever it is I'm doing, and that's the size of what you guys are doing. So maybe I'll catch up one of these days. But I'm not that motivated anyways. So we'll see.
Yeah. Awesome. Well, this was great. I want to do a lot more of these this year. We've had some good ones. Vacation's over for the most part. So we need to do this more regularly.
I have some ideas. I have some ideas for some guests. Obviously, I'd love to chat with you about it offline. I'd love to hear from the audience if anyone has any guests or guest types. We try to stay kind of outside the real estate industry when we do this stuff. We like to bring people from other industries in because we feel like there's a lot of fresh ideas and whatnot. But we'd love to hear from you guys. If there's anybody you guys would like for us to have on, we'd love to reach out to them.
Yeah. Topics too, it doesn't always have to be real estate, but we really very much appreciate all you guys that listen, either live or the recordings or listen to the podcast. Your support is greatly appreciated, both with that and in our everyday business. So Thank you all very much.
Absolutely. Max, thanks a ton, man. I'm sure we'll talk really, really soon. I'm very much looking forward to the next one of these. So thank you.
Yeah, me too. See you guys.
See you later. All right, so we got to